If you're nearing retirement, you need to be looking at dividend stocks. As you get closer to your last day of work, finding a stable and reliable source of income to cover your living expenses should be the most important factor in your investment picks. But how do you determine what stocks will pay you for the rest of your life? Today, we're taking a look at one of the single best investments you can make if you're retiring, and that's Lowe's Companies Incorporated. This home improvement company has the most stable and reliable dividend income on the market, and its income growth is unmatched in any sector. So here we're on Lowe's homepage, and you've probably heard of Lowe's before, but just in case you haven't, they're a home improvement company. They're basically a direct competitor to Home Depot. You've probably heard of Home Depot, but they're kind of a general purpose home improvement company. You can buy lumber there, you can buy appliances, plumbing, materials, stuff for landscaping, all different kinds of stuff. And I won't go too much into what Lowe's does as a business because you've probably heard of them before, but just bear in mind that with the inflation that we've been seeing over the past couple years, Lowe's has seen a huge explosion in their income. You probably remember in 2020, early 2021, when lumber was going just absolutely parabolic, like lumber doubled in price over a year and a half or something like that. Lowe's definitely saw a lot of that income growth. Um, so that's a little bit about what Lowe's does. Now, their current dividend yield, we're over here on Desperado dashboards, and we can see that their dividend yield is 2.02%. And this is coming off of a slight dip in their share price over the past little bit. Let's see, their 5-year average dividend yield, this is on Dividend Radar, 5-year average yield is about 1.7. And we're looking at a dividend yield of a little over 2%, right around 2%. So not a huge spike in their dividend yield, but they are trading slightly lower than they have been historically. So we're seeing a jump in the dividend yield there. And also, if we take a look at their dividend history, let's just look at their 3-year history really fast. We can see that there's been a huge jump in the actual dividend amount also. So that's also contributing to the spike in dividend yield. So a 2% yield, that's not huge, but really what I want to focus on are the dividend growth rates. Now, if we go over here, we can see the 10-year dividend growth rate, 5-year, 3-year, and 1-year dividend growth rate. That's those 4 boxes here on the bottom. And over the past 10 years, we saw almost a 30% compounded annual dividend growth rate. Now that's huge. If we get dividend growth rates around 10%, I'm more than happy. So the fact that we're seeing triple that, almost a 30% 10-year dividend growth rate, that's incredible. And if we look at the 5-year and 3-year, we're seeing growth rates pretty much around the same as the 10-year growth rate. Looks like our 5-year growth rate is slightly lower, 3-year is slightly higher, and then over the past year, we've seen about a 22% increase in the dividend amount. So maybe they're slowing up just slightly on their dividend growth, but if we look at the full dividend history, we can see that they have been increasing their dividend all the way since 1985 and before that. Really, their dividend increase streak is 61 years currently, so that's a huge increase streak. But really, it's around here in 2016, 2018 that we really saw the dividend go parabolic. I mean, these increases, especially over the past couple years, likely due to inflation, like we were mentioning before, have just been absolutely crazy. And I don't know if the current inflation rate will continue or if it'll slow down or anything like that, but definitely if inflation continues like it has been over the past couple years, this dividend increase is likely just going to continue like this, because I don't think Lowe's as a company is going anywhere anytime soon. They've got too much of a foothold in, home improvement and the consumer staples sector. They're definitely a household name. So those are our dividend growth rates. Very, very strong dividend growth. I mentioned earlier their dividend increase streak was about 61 years. And that puts them definitely in the dividend champion category. Now, I'm not sure if they're a dividend king. So to be a dividend king, you have to be in the S&P 500 and have a dividend increase streak of more than 50 years, and then also meet some market capitalization and trading volume requirements. So I'm not sure if Lowe's meets all of those criteria. I'm not sure if they're in the S&P 500, but they're definitely a huge company, have a large market capitalization, and the increase streak is incredible. I mean, it, I don't really purchase dividend stocks that have increased streaks lower than 10 years, but anything over 50 years, especially if the numbers work out, is an automatic buy in my book. So, we were mentioning earlier how if you're entering retirement, you really want a stable source of income. You don't want to be looking at you know, a company that might have huge dividend growth in the future or that might have a large share price appreciation in the future. You really want something that'll give you income today and will continue to provide you with your income to cover your living expenses and, just live your life and have a good time in retirement, without stressing to know whether or not they're going to cut their dividend. And really, that's a question of dividend safety, which is primarily a function of the payout ratios. So a payout ratio is just the percentage of some income metric that's paid out in dividends. So here we're looking at the payout ratio on net income, which is kind of the traditional way to measure a payout ratio. But I also like to calculate the payout ratios on operating cash flow and free cash flow. So net income is in this gray box, operating cash flow is the red box, and the black box is the free cash flow payout ratios. And you can see here we're looking at the annual payout ratios for the past 5 years. And generally, I like to look for companies with payout ratios below 75%. And that's what this little dashed line here is. That's that 75% mark. And we can see that over the past 5 years, all three of these payout ratios have been below 75%. And actually, it looks like back in 2019, their payout ratio peaked at 62.88%. So very, very safe payout ratios. That means that they can experience a pretty hard hit in their income. Their revenue can drop, their sales can drop, and very likely they won't cut their dividend because they have a little bit of breathing room. And the reason why I like to look at free cash flow and operating cash flow is that's a better measure of, the money actually coming in and going out of the business, whereas net income can be slightly manipulated based on, it's more of an accounting measure than it is an actual business metric. So, just something to be aware of. And we can also take a look at their quarterly payout ratios. And this is just from their quarterly income statements instead of the annual income statements. And we can see that, their payout ratios are a little bit higher here, but keep in mind that these are not aggregated over the whole year, where really these annual income statements are more formal, they're more heavily vetted, and typically, especially when I'm looking at payout ratios, I just look at the annual income statements. So based on all that, their dividend growth, their payout ratios, and the increase streak, we're looking at a dividend that's very, very safe. And the last thing I want to look at in terms of dividend safety is actually their financial growth. And I like to look at the financial growth of net income, operating cash flow, and free cash flow. And this will basically tell us, is their revenue keeping up with their dividend increases? Because, these payout ratios are based on what their revenues were for that year and what their dividends were for that year. Now, if their income starts to drop and their dividends keep growing, you can imagine that eventually these payout ratio bars will hit that 75% mark and go up and up and up. And really, once a company's paying more than 100% of their income, whatever it is, if it's the net income or operating cash flow or free cash flow, if they're paying 100% of those metrics over a given year, and they do that year over year over year, eventually they're going to cut their dividend. So we want to make sure that our income growth is keeping up with our dividend growth. And we can see that on net income, over the past 5 years, we've been trending up at 27.67%. And this is a trend line growth. It's not the literal growth. It's not this growth from 2019 to 2023. It's more of like a trend. That's trend line growth. Anyway, operating income has been growing at about 26%. Operating cash flow, almost 14.5%. And free cash flow, almost 15.5%. So that's really, really strong growth. I mean, if we're seeing growth above inflation, 5% or more, then that's really good in my book. That's typically what I like to see is growth above historical inflation, but we're seeing growth well above that, which to me, that makes for a very, very safe dividend and one that will likely continue to grow at about that rate or about what we're seeing over the past 10 years, for the foreseeable future. So that's kind of all there is to analyzing the dividend. Let's actually see how much we can earn investing in Lowe's, because if you're investing for retirement, maybe you're not thinking about the super long term, not 40 years down the line, but you want your income to be growing with inflation and with just your general living expenses and things you want to do in retirement. I imagine you want to travel and you want to provide for your family and everything like that. So what can you expect to earn? Say let's do 10 years from now. We'll do 10 years and 20 years. So we're going to invest $10,000 in Lowe's, and this is their current share price, $228.05. That's roughly what their current share price is, I think. Let's go over and check that on NASDAQ really fast. Today, yeah. See, as of 3 p.m., their share price was $228.42. So we'll just keep what MarketBeat is giving us. Our initial annual dividend is about 2%. Expected annual dividend amount increase. Now, MarketBeat gave us this 22.86%. I'm thinking it's going to be a little bit higher than that, just based on the 10-year trendline growth. So we'll say 25. Now, share price appreciation. If we go, let's go back to NASDAQ really fast. And if we look at their max time frame for their share price growth, we're seeing fairly steady growth between 2014 and say 2020. And obviously they had a dip in 2020 from the virus that shall not be named. And looks like they peaked around 2020, end of 2021. And that's probably, due to the inflation effects that we were talking about earlier. They've kind of been trading sideways. So I anticipate that we'll be seeing growth more like we saw between 2014 and 2020 over the next 10 years. And that's fairly conservative growth. So I would say that a 3% annual share price appreciation is reasonable. And just doing a little bit of housekeeping, our investment type is an individual stock. We have a quarterly distribution. And I guess if you're in retirement, you're not going to be drip investing, right? You're going to actually be collecting on this dividend. So let's see what that would look like after 10 years if you're actually collecting on this dividend. So your yield on cost after 10 years is about 15.63%, which is pretty crazy, right? And that's all a function of the dividend growth. Like if we're seeing dividend growth over the next 10 years, like we have seen over the past 10 years, then your yield on cost after 10 years is almost 16%, which means that after 10 years, that $10,000 investment will yield you about $1,800 every year. So on the 10th year, you'll be seeing about $1,800 spread over those 4 quarters. Now your average annual return is just the share price appreciation because drip investing is turned off, so you're not getting any additional return from the reinvestment. Now, let's see what'll happen. Say you live a long time and you're still holding Lowe stock 20 years from now. Now, this is where it gets really crazy. Look at our yield on cost. Almost 190% just from the dividend growth. Now, that's assuming that we continue the same pace that we've seen over the past 10 years. And that's a pretty crazy rate, to be honest. We might not see that over a 20-year time frame, but if we do, hey, that's awesome. That means that after 20 years, a $10,000 investment will give you every year almost $23,000. On that 20th year, you're looking at $23,000 in income just from one buy. So that's really cool. And if you're nearing retirement, let's say you're actually but you're 10 years out from retirement, you're starting to think about, making your stock picks a little bit more stable, less volatile to, market fluctuations and things like that. And typically, dividend stocks are a little bit more stable. If the market drops, say 40%, dividend stocks may drop, only 20%. It all depends on the beta factor for the stock, which you can look up at different brokerages, or I'm sure other stock websites will have that data available for you. But let's say, you're 10 years from retirement, all the other factors will hold equal. And what are we looking at in terms of income? So your yield on cost is almost 23%. And I think, what was it, like 18% when we had the drip turned off. And our average annual return is just less than 8%. So I think what people typically say is that the S&P 500 index over the past, 50, 70 years or something like that has grown more or less at 8%, maybe 10% annually. So if we have all of this dividend growth and we have our reinvestment turned on, we're actually almost meeting the S&P 500 index just through dividend reinvestment, which is pretty cool, especially when we're only seeing a 3% annual share price appreciation. So that's basically it for this video. I saw this pop up on Dividend Radar, and I have a little screener as part of my website here. And Lowe's came up as the top stock based on my scoring criteria, which just looks at, dividend growth, financial growth, the payout ratios that we looked at before, the initial yield, and I think that's about it. And the dividend increase streak as well. And that came up as the number one highest scoring stock in that screener. So I just had to do a little video about it. And it definitely seems like more of a late stage buy. Like if you're younger and you're looking for more, growth with the market and overall returns, then perhaps something in the S&P 500, or maybe even just a S&P 500 index fund like a VOO or something like that might be it might make a little bit more sense. But if you're older and looking for income, I think Lowe's is an incredible pick. Obviously, it's not financial advice. You should go and do your own research. I'm sure there are a lot of conditions that I wasn't able to cover in this video. But yeah, that's kind of all I've got for this one. We're looking at these types of stocks all the time. I'm always improving my screener. I'm always looking at this Dividend Radar spreadsheet and doing these types of analyses for you guys. So make sure, if you like this content, go ahead and subscribe, because I put out videos like this a couple times, maybe 3 times a week. And you never know when a stock is going to drop and a yield is going to spike, and then a buy is a really, really good idea no matter what position you're in. So make sure you subscribe, turn on notifications just to get notified whenever that happens. And that's it for this one, guys. Thank you so much for watching. As always, stay safe and take it easy.